After a hideous day, we need to take a step back, try to assess things objectively, which is very hard to do when you get this kind of emotional sell-off. You don't want emotions to be dictating what you want to do. You want to be logical. And that's why tonight we're going off the charts with the help of Bob Moreno. He is a brilliant technician who happens to be my colleague at realmoney.com, where I blog, as well as being the publisher of rightviewtrading.com. Get a better read on this market because, holy cow, this guy's got a terrific track record. His chart work allowed him to call the bottom last December. How great was that? And he predicted that the stocks had much more room to run right in February, when the S&P was already up 16% from its lows. And a lot of people were arguing that maybe it'd run out of steam, but he nailed it. However, when Moreno predicted more upside 8 months ago, he also gave us some warnings. So I want you to take a look at this monthly chart of the NASDAQ, okay? This is a logarithmic chart where each tick represents 1%. Rather than 1 point, okay? Technicians like them because they're better at defining trend lines than traditional arithmetic charts. Now, in February, remember, Moreno argued that we were facing a consolidating period, not unlike what happened in 2011 and 2015, where the averages trade sideways in a fairly wide range. In both cases, the NASDAQ traded in a 21% range. Each of those periods lasted for roughly 15 months. So back in February, that meant we still had more room to run before the NASDAQ hit the ceiling, because the consolidation period had only been going for 7 months. We had 8 more months to go before he expected the pattern to end, which brings us to right now. While the NASDAQ has made new all-time highs during this period, we're now hitting that 15-month mark that we're supposed to be worried about. That's why Moreno believes the period of consolidation is ending. And now he expects not a break up, but a breakdown. That's right. This is a top call. Perfect on a day like today, huh? Not just for the NASDAQ, but for the Dow and for the entire S&P 500. So listen up, especially if you saw the action today and you're concerned. What makes Moreno so pessimistic? Well, check out the S&P 500's weekly chart. I know there's a lot here, but we're going to go over it. After rebounding from its lows last December, the S&P started making a pattern of higher highs and higher lows. We love that, right? That's typically the kind of thing that it's great to see. So it was bad news when that pattern got disrupted last month, when the S&P started making a lower high. Okay, so this is when we all started to get in trouble. This reflects a complete loss of momentum. Sure enough, it also coincides with a pullback in the slow stochastic oscillator. It's a tool that tells you whether securities have gotten overbought or oversold, and that's the SSTO. Meanwhile, there's also the Bollinger Bandwidth, okay, not the regular bands, but Bollinger Bandwidth, which measures the S&P's volatility. We talked about the Bollinger Bands before. You normally see them as 2 lines that represent the stock's standard deviation over the last 20 periods. The Bollinger Bandwidth shows you the percentage difference between the upper band and the lower band. Basically, this is a measure of volatility, and lately the volatility has been surprisingly low. Now, see, that's a problem for Moreno. Volatility tends to be cyclical. It expands, it contracts, it expands again. Right now, the S&P's Bollinger Bands have contracted to exactly where they were a year ago, right before the horrific market-wide breakdown. The weekly chart isn't too ugly, but it's standing on a precipice. And you were talking about right here. Okay, this is a precipice. In other words, Moreno thinks this setup has the potential to result not just in a decline, but a sharp decline. How sharp? Why don't we zoom in on the S&P 500's daily chart so you get a real sense of how we're kind of in a danger zone here. When you look at the daily, you can see that the S&P has formed a kind of horizontal channel pattern over the last 3 months. We got a firm ceiling of resistance, right, formed by the S&P's new high over the summer at a little over 3,000. Moreno thinks that the highs in July and August may mark, yes, this is what you really don't want to see. You know what that is? It's called a double top. It means we peaked. At the same time, though, we've got a powerful floor support at around 28.25. Hope, right? That's where the S&P repeatedly bottomed when it sold off in August? No. Moreno's worried because sooner or later, the S&P is going to break out of this box, either to the upside or the downside. He's betting that it's going to be the downside that's more likely. Now, Moreno believes the S&P is going to test its floor of support again. Only this time, that floor is at 28.25, okay? But if it fails, and he thinks it will, another floor at 27.25. That's where the S&P bottomed in March and June, okay? Got me so far? He's thinking it could go down to where it was in March and June. All right, well, garden variety sell-off. Wait a second. Unfortunately, he doesn't see that trading floor, that floor holding either. No, if the S&P breaks down from the current consolidation pattern, we could have not a little, but a lot more downside. When you look at the trading range, the index has been stuck in, then subtract that range from the floor support. That is what technicians call a measured move. You end up at 2,600. Jeez, it's been a while since we've been there, huh? Remember that period? Wow, okay. Sure enough, the 2,600 level happens to be the intersection with the S&P's long-term trend line from the monthly chart, almost exactly. So what we would do is we wouldn't go back to where we were in December, but we would certainly give up a lot of what we gained, right? I found this very worrisome, and that's pretty grim. Moreno's basically predicting a 10% decline from these levels. Now, what makes him so bearish? Okay, for starters, there's the moving average convergence divergence, or MACD indicator. That's right here. It's a tool that helps detect changes in a security's trajectory before they happen. The MACD recently made what is known as a bearish crossover. We've seen so many bullish ones. This is a bearish one, all right? That's where the black line drops below the red one, and it's pretty reliable negative tell. See that right there? Okay, that's very bad. Plus, it's below the center line. Here's the center line. That reflects the S&P 500's ongoing loss of momentum. Another sign of reversal. Okay, now let's go back to Mark Chaikin's indicator. This is the Chaikin oscillator, a momentum gauge developed by the great Mark Chaikin from Philadelphia. We've consulted him on or off before many times. Now, Chaikin's oscillator is a derivative of the accumulation distribution line, which means it measures money flow. Think supply and demand. Are investors eager to buy the S&P 500, or are they desperate to sell? Or are the two sides roughly even with the buyers and sellers balancing each other out? Given that the Chaikin oscillator is dropping below its center line, well, I guess I don't have to tell you what that means. Yeah, negative money flow. Put it all together, Moreno believes we're really cruising for a bruising here, even after today's ugly session. He's hoping the S&P 500 can find a floor at the 2,600 level. Don't you hate that hope, right? That's still a long way from a retest of last December's lows, but it's pretty horrible. If the floor at 2,600 fails, then, well, I don't even know. He did say when we talked to him that if this fails, we could revisit this level. I mean, I'm sorry to be such a negativist. Well, it's not me, it's Moreno. I want that, by the way, on Twitter, people often say, well, that's Jim's chart. It's not mine, okay? It's Moreno's. I know it's not what you wanted to hear today on an ugly day, but when a technician with a terrific track record who called a bottom for us before tells us to beware of a 10% decline, you better believe we take him seriously. And while you don't have to take your cue from the charts, it pays to be aware, at least, of what the people who've been right are saying, doesn't it? The bottom line, back in February, the charts, as interpreted by Bob Moreno, told us that the S&P 500 still had more room to run, about 200 points more. As it turns out, it was closer to 300. But then the market did exactly what Moreno predicted. It peaked. And then it spent months bouncing back and forth. Now those same charts tell Moreno that we're approaching an important moment, and he's predicting a major sell-off from these levels, a 10% decline in the S&P. Do I agree? Moreno's views echo my own for vast swaths of the market, for certain. But as someone who likes individual stocks, I'm ready for the chance to buy best-of-breed names at bargain basement prices. But look, when a guy calls it here and he calls it here, who am I to say that he's not going to call it right there? Let's go to Steve in New Hampshire, please. Steve.
Jim, like you, I'm from Brooklyn, Queens, and Jersey, so triple booyah to you.
Holy cow, man, we are just kindred. I really feel it. I'm really feeling it now, Steve. What's up?
Thank you. Please, as you've taught me to do my homework, getting ready for corrections, if I have my pre-made list of about a half a dozen growth stocks, small, mid, and large cap, and about a half a dozen value stocks, small, mid, and large, what would I go with when there is a broad major correction? The growth, the value, or a combination of all, and at approximately what percentage in numbers would I do that in as a correction when the market's down 5%, 6%? What would you recommend?
The most important thing is, do you like the companies, not the size of the companies? Way too many people got caught up in the mumbo jumbo of the Russell 2000 or the S&P or the Dow. I need you to like the companies and buy the stocks of those companies on the way down, regardless of the size. Let's not get caught up in the terminology. Let's become students of the companies themselves. And I agree that the market is going down. But I do think that there's, as I said at the top, there's some things worth buying, but they're few and far between. Tonight's chartist is pretty pessimistic. He's expecting a 10% decline in the S&P. I hope he's wrong, but hope should never be part of the equation. And man, has he ever been right. Okay, but on a daily trade, he doesn't feel like he's going to be dead right. Much more Mad Money happened. It seems as if breaking up is quite easy to do, at least on Wall Street. And the industrial sector seems particularly eager to break up. So tonight I'm sitting down with the CEO of Emerson Electric, a formidable CEO who really understands business and been around for a long time, to figure out if there's something to spin or something to keep whole. Then not all yields are created equal. I'll tell you which companies could be worth eyeing in an uncertain market. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.